Check this out. The odds of a hike. Oh, that was for September. And for the hike all year, about a coin flip, 54%. But it was as high as 67% earlier this month. Joining us now is Tom Porcelli, the chief economist at Wells Fargo.
That was hard for you to say, right?
She was very deliberate about it. Very deliberate about it. Very deliberate.
It's great to see you.
Good to see you both.
And remind me which camp you were in coming into the report.
We're on the hold.
The
hold camp.
All right, so
yeah, we've been there. We've been there. We still expect it.
Earlier this week, we had people saying 3 hikes couldn't be ruled out, and you still think none.
No, yeah. Look, I think the argument for hiking seems to obviously rest on the shoulders of inflation. And we would argue that this is not the kind of inflation that the Fed could actually impact. And so in that context, raising rate, we've said this many times, raising rates is not a costless endeavor, right? Like, I get it. Yes, you will hit inflation to some extent, though the impact is actually modest. But you also hit growth.
But why do you see the impact? So I'm going to quote Diane Swonk from last hour, and she's been very hawkish, and she's saying this is ridiculous. Inflation is too bad. The Warsh himself says the Fed has to do something about it. So how can you...
No, it's the right discussion point. So what we would say is think about the things that's actually driving from an inflation perspective, right? It's tariffs, supply shock, and it is energy, which is also supply shock. If you want to go back like even 2.5 or 3 years, you can then throw in auto insurance and auto repair, which I know sound like inconsequential categories to most people.
Those were big ones, but you're saying
were massive.
We're only down to tariffs and oil.
Yeah.
That's it.
So if you look at it, this to me is, I think, a conversation that people should be having in a bigger way. If you look at something like core CPI and you look at core PCE, do you know that they've diverged? There's been actually a pretty sizable divergence between the two. And I would actually argue if you ask people, hey, what's core CPI running at? I think most people actually don't know. It's actually running at a 2.5% pace.
I would have said 3.1.
Yeah. And if you actually look at it on a 3-month annualized basis, which is a really fair way of getting a sense for short-term trends, it's running at a 2.2% pace.
So pretty much on target.
Yeah, exactly. So again, I think people have to ask, it's not enough to say inflation is elevated. I think you actually need to ask the why. And the why in terms of the divergence between CPI and PCE is because the weights are different, right? Like there's just less weight on housing.
And they're about to change it again. I mean, this whole thing. So the conspiracy theory is the Fed's going to change PCE in order to justify not hiking. What would you say?
No, I think that these are actually changes that they should be making, right? Like portfolio management fees, they're going after tech. They're going to alter the weights there to some extent. I would actually argue that these are changes that are actually warranted at this point.
It's also interesting as well, because if you look at the way the markets are interpreting all of this, an interesting point stood out to me. Richard Bernstein Advisors had kind of put out there in the ether and in social media this kind of chart that showed the prices of copper, right? And then vis-a-vis the target Fed funds rate. And this is what we're showing you right now. And the argument that RB Advisors is making is that if you look at this, the price of copper futures, suggests that you need to hike interest rates in order to kind of catch things up to where certain parts of the macro market are. Is this true in your mind? Do you think that we need to have this kind of a reaction from rates to accommodate for price movements like this in certain parts of the market?
So here's I think, the right way of thinking about this. I think, one, you need to ask what problem are we solving for? And if it's a supply shock and you actually really can't affect it, then I think we need to sort of keep that in mind. And by the way, as an aside, I would say if you think about tariff prices and where it actually flows through to, it obviously hits durable goods prices. Durable goods prices are in a perennial state of deflation. Not disinflation, deflation always, except for May of last year when they started to rise, and now they're +3. But for the prior 35 years, right, outside of the COVID window, they've been in a perennial state of deflation. Now ask yourself this: what has actual durable goods spending done in the wake of that? And by the way, I'm talking about real spending, which everyone knows that means inflation adjusted. But I would actually argue it also means the volume of spending. And the volume of spending on the back of that has actually slowed. And it's not so the consumer was self-correcting, which I think is fascinating in and of itself.
And sort of tells you there's not a broader inflationary impulse because you can't just keep. Let me ask you this.
That's exactly right.
We've heard